and welcome to the latest Smaulgld podcast. This one is called the Yellen Call Option. Today we're going to be talking about recent discussions by Janet Yellen about the efficacy of the Fed purchasing shares. Fed Chair Janet Yellen hints the Fed buying of stock would be a useful addition to the Fed's toolkit. Buying stocks solves the Fed's problems of raising rates. If stocks fall because rates rise, the Fed can boost them back up by purchasing depressed shares. So you can see this is a very clever fix. It's a stupid idea, but it works for what the Fed is trying to do. Now, I think any Fed share buying would harm gold. We'll talk about that as well as we get into the podcast. And another reason the Fed needs to buy shares, or wants to buy shares, is if it wants to use accommodative monetary policy in the form of negative interest rates, that really would harm the dollar standing as the world reserve currency if it doesn't pay any interest rates. So the Fed is desperate to find a solution towards their need to raise rates and not go negative or not even keep them at zero, and their need to, or in their minds, to boost the economy. So we call this the Yellen Call Option. It indicates that the Fed not only wants there to be a floor on stocks, they actually want to boost stock prices so that investors gain a windfall. And the Fed themselves would gain a windfall if the stocks they buy go up. Now, in Janet Yellen's Jackson Hole speech back in August, she set the stage for this whole discussion. This is very clever how they do this. They introduce these concepts and they get others to talk about it. And next thing you know, it's happening. It's established policy and everyone's doing it. But at Jackson Hole, Janet Yellen had a speech called the Federal Reserve's Monetary Policy Toolkit, Past, Present, and Future. And she's talking about future recessions. At the same time, she's talking about how the economy is on solid footing and we need to raise rates. And in that speech, the part that I picked up on, and at the time, and has since been exploited a lot by Janet Yellen and so-called intellectuals and economists that are supposed experts on monetary policy, and she said that on the monetary policy side, future policymakers might choose to consider additional tools that have been employed by other central banks. See, everyone's doing it. Though adding them to our toolkit would require very careful weighing of cost and benefits, and in some cases would require legislation. That set off bells in my mind because that means buying things they're not allowed to buy currently. She says then, for example, future policymakers may wish to explore the possibility of purchasing a broader range of assets. Now, what could that mean? Stocks, I was thinking. Beyond that, and then she goes into a bunch of other ways that the Fed could handle a future downturn. But she then concludes saying, I should stress that the FOMC is not actively considering these additional tools. Of course, this is purely theoretical, just to kind of chat, just because she wants to say something. Although they're important subjects for research in the future. Okay. She's not saying this because she wants people to research it. They've already looked into it. They know they want to do it, but they can't just come out and say they want to do it. Just like when they did QE. They knew once they started QE, it was going to go through several iterations, and they were going to print $4 or $5 trillion, but they can't come out and say that. They have to make it sound like it's some kind of emergency one-time measure. Same thing here. They're not hell-bent on buying shares. They only want to look into it, and it's just for future research, nothing we're considering now. Hey, we're all just talking and chatting. We're in Jackson Hole just to kind of hang out, and this just came to my mind. No way. The Fed wants to buy shares. The Bank of Japan already buys them. The Swiss National Bank already buys them. The Fed wants to buy them. Now, last week, Janet Yellen had her testimony on Capitol Hill. And when she was asked directly whether the Fed wanted to buy stocks, she said, we're not really asking to buy stocks. So the congressman said, are you looking to the possibility of purchasing equities to your toolbox as part of your monetary policy? And she says, first off, well, the Federal Reserve is not permitted to purchase equities. We can only purchase treasuries and agency securities. Boo-hoo. And then she says, I did mention in a speech in Jackson Hole that it may be difficult in providing adequate monetary policy in the future, and that, maybe down the line, this is the kind of thing that Congress might consider. Of course, not that she might consider, something that Congress might consider. But if you were to do so, it's not something the Federal Reserve is asking for. Now, this is very coy, very clever. It's like saying, I don't want to go on a date with you, but if you asked, I wouldn't say no. Come on. She's telling Congress this is what she wants, but she's saying, why don't you guys think about it? And then why don't you give us that power? Now, the next day in a conference with bankers, Miss Yellen said, buying stocks, it's not pressing and it's prohibited by law, but it could help the economy in the next downturn. Like somehow buying shares is going to help the economy. No, it's going to help the stock market. It's not going to help the economy. But she says, we have that prohibition, and our toolbox, though, may reach the limit in the terms of purchasing safe assets like longer-term government bonds. So they've already made it normal that when there's a problem, they can print money and buy government bonds. Now they're saying, well, that may not be enough. Our toolbox may not be big enough. We have to put corporate bonds and corporate equities into the toolbox. So she says it could be useful to be able to intervene. There you go, intervention, directly in assets where the prices have a more direct link to spending decisions, such as buying equities. And buying equities and corporate bonds, of course, have costs and benefits. So basically, Janet Yellen has never met an intervention she doesn't like. She's met some interventions that she's not allowed to do, but this is one where they clearly are looking to buy shares. It seems the only thing stopping the Fed from taking the buying of stocks under consideration is the law prohibiting them from doing so. Now, a problem with boosting asset prices via stock purchases by the Fed. All they're doing is boosting the price without boosting profits or productivity. If there's no corresponding increase in productivity and just the price goes up, it's them changing the price unilaterally without any additional value created, without any additional production. So don't expect the economy to do better just because the stock prices are higher. They're the same companies. And the incentive for those companies to create further value is reduced even more, because the Fed, if the price of the stock is going to rise without you having to increase profits, merely because your company's in the good graces with Miss Yellen and co., then why bother to become profitable? The Fed protects your stock price on the downside and then gives you some upside. If the price goes down, they just buy more. It's like, why don't we just say you won, we'll skip the race, you win. That'll create a very undynamic corporate America, or corporate anywhere, wherever they tend to be buying stocks. And the only people who benefit from buying these stocks are, of course, the holders of the stocks, the rich people who own the shares, the Fed's portfolio, and of course, the cronies that are running the companies that have stocks and stock options. Now, this all started, you have to blame Greenspan for a lot of stuff. In 1987, when the stock market crashed 20%, I think it was October 19th, he had just been appointed by Ronald Reagan, and people had high hopes around Greenspan. He was a libertarian and ran free market, Austrian economist type guy who believed that gold was a way of preventing governments from overreaching and doing deficit spending. And you would think, and he was appointed by Ronald Reagan, who was supposedly a free market conservative, that, well, when the stock market crashed, they just let it crash and let the chips fall where they may, and the bad assets would continue to stay low, the good assets would rise, and there'd be a cleansing of the stock market and the economy. But nope. The next day, the Fed issued a statement saying, the Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Later, and the stock market rose. Later, in the spring, Ronald Reagan, by executive order, created the President's Working Group on Financial Markets, which includes the President, the Treasurer, Secretary of Treasury, the head of the Federal Reserve, the head of the SEC, and their job is to make sure the stock market doesn't go down, is to intervene. So since 1987, you have not seen a prolonged stock market protraction. They have not allowed the stocks to fall for very long. So you've had Fed intervention since 1987 to make sure that the stock prices never fall. There used to be periods in the 60s and the 70s. You'd have years of bear markets. We haven't had that since 1987. They won't allow it. Now, when Fed Chairman Greenspan was in office or holding the position of the chair, he would lower rates, and that would cause capital to flow into equity markets whenever the stock market fell. And this was called the Greenspan put. And after the bust in 2001, which he caused by raising rates after having lowered them, he then started lowering them again in order to reflate the stock market. He lowered them all the way down to 1%, created a housing craze, and boosted the stock market again. And then when the housing market burst, and we had all the financial crisis of 2008, the new Fed chairman, Ben Bernanke, he did the same thing. He started lowering interest rates. He lowered them all the way down to zero. He engaged in quantitative easing, printing money, buying government bonds, buying mortgage-backed securities, and that did the trick, pushed the stock market higher. So the Fed learned that lowering interest rates boosts the stock market and that raising them clobbers it. That's why the Fed has only instituted one rate hike, December 2015, over the last 10 years. And then when they did, a massive stock sell-off followed that one rate hike in January in 2016. We had the worst stock market beginning of any year. Now, during that time period, Greenspan and Bernanke were constantly criticized that by artificially boosting the stock market, they had created a moral hazard. They encouraged what's known as malinvestments, because those investments that went higher really shouldn't have gone higher because their underlying fundamentals weren't there, and that entrepreneurs and investors were tricked into making these speculative investments by the low interest rates. And under Austrian economics theory, when the real value of these companies become known, the malinvestments crash and they'll be liquidated. But not in today's central bank controlled economy. They're never allowed to crash. For more on this theory, I've read a post, Are Entrepreneurs Really Tricked by Artificially Low Rates? I say they used to be, not anymore. They know if the Fed has your back and the Fed is always going to keep rates low or buy stocks, you're not tricked. You know what the game is. You're foolish not to play along and ride the stocks higher with the Fed. Now, here comes the Yellen put. While Fed Chairman Greenspan and Bernanke protected stock investors from downside, it looks like Ms. Yellen wants to allow the Fed to buy stocks and give and promise investors upside. So the Fed has been unwilling or unable the last year to raise rates, or the last 10 years, without spooking the stock market, which is one of their goals. And they also realize that they also have to support the dollar, which one way of doing that is by raising rates. And they need also to get people to buy U.S. Treasury bonds, because that's how the U.S. government, Treasury, funds its welfare warfare state by a massive deficit spending. So they need those bonds to pay a positive rate of interest. So they're in a bind right now. They want to boost the stock market, but at the same time, they don't want to raise. They want to raise rates to boost the dollar, but they also want to boost the stock market. And they realize that those two objectives are working at cross purposes. So the solution brewing seems to be raise the rates so you can put some room between U.S. debt and the other sovereign entities that are offering zero or negative rates, and then mitigate any stock market fallout by buying shares. If only Congress would let them. So if a stock market crashes, you know that Congress has already been put on notice that there's a ready-made solution to avoid this negative event in the world. The Fed will just have to be given the authority to buy stocks to reflate the stock market. Now, what does this mean for gold if the Fed starts buying stocks? Well, first of all, the Fed is not going to buy gold. The ECB doesn't buy gold. No central bank buys gold. The only central banks, the only central banks that buy gold are these two guys, Chinese and Russian. The rest of the central banks don't buy gold, haven't bought gold. In fact, some are selling. Canada sold all of its gold. England sold a vast amount of gold, doesn't have much left. So central banks don't buy gold. Well, if central banks aren't buying gold, other than China and Russia, but they are buying shares, you've got a floor on shares, you've got some upside in shares based on central bank intervention, but there is no such central bank put or call protection for gold because they don't buy it. Now, If buying corporate bonds and stocks is more attractive to central bank than lowering rates because negative rates favor gold, then you're in trouble with gold, because one often cited reason not to buy gold was that it didn't pay interest or dividends. But that argument, that anti-gold argument, has gone away with the advent of negative rates. The central banks don't like that because people are thinking, wait a minute, I can hold gold, I don't have counterparty risk, and I don't lose any money. I don't have to pay money at the end of the term of the bond if I own gold. So central banks, I think, are starting to catch on that negative rates open a window for gold. And the way they close that window is to stop the negative interest rates and just start buying assets. And that gives them greater control, maybe not over the overall economy, but it gives them greater control in many other ways because they start to control companies as well. Now, where would the Fed get the dollars to buy stocks that wouldn't cause price inflation? No, people think that, well, if the Fed were to do this, this is good for gold because now the Fed is printing more money. That creates inflation. Inflation is always good for gold. Well, in this case, not really, because the purchase of the shares would cause inflation, but that inflation would be of the shares that it buys. The share price would increase. The shares that it buys directly would increase, but it wouldn't create price inflation in the rest of the economy. If the Fed were to buy Boston real estate or Pablo Picasso paintings, the prices of those assets would rise, but the price of everything else wouldn't rise. So holding gold isn't going to protect you from an increase in the price of Pablo Picasso paintings, Boston real estate, or X, Y, or Z shares. Now, why is the Fed doing this? Well, they're doing this because they have created the concept, it's an illusion, that the stock market is the economy. It's not supposed to be reflective of the state of the economy. It is the economy. And that's why you have today, you have growth or negative growth globally, 1%, less than 1%, 1.2% in the US, 1.5% global, whatever it is. But yet, the stock markets are screaming higher. You've got companies in the United States make little or no profits, never will. They got multi-billion-dollar market capitalizations. Under a Fed stock buying plan, profits will become even less important. So then rather than servicing consumer aims, companies will start thinking about, especially the ones that the Fed buys, servicing government aims, such as enhanced surveillance, whether they're involved in green energy, they'll get a benefit for that, hiring refugees, rather than servicing the customer and trying to make a profit. Now, normally a company's worried about, well, what happens if I do those things and the stock price goes down? Not to worry, you got the Fed there. If you're a favored company and you've lost a little money because you've served a government objective, well, they'll take care of that. They'll make sure the stock price doesn't suffer as a result. In fact, they may create that as one of the non-financial metrics that you hit and therefore should be rewarded. Maybe you hired refugees. Maybe you opened like Yahoo did just the other day, you opened your emails to allow the NSA to look at them. Now, what are some of the dangers of the Fed buying shares? Well, crony capitalism is just totally institutionalized at that point. If the Fed buys voting shares, it can begin to gain control over companies and direct corporate policies, including hiring, who they hire, how they hire, what percentage of which ethnic group they hire. They can control corporate donations. They can decide to borrow to declare dividends or buy back shares. They have the power to issue debt, and they can issue debt and then have the Fed buy it. They have the power to forgive non-performing debt and or to convert that debt to equity. So basically, once the Fed owns a large voting share, they can get others to vote with them to create policies that are basically just self-dealing. Now, if the Fed buys non-voting shares, it just makes it easier for others to control the company as the Fed's voting block is neutral. It totally distorts markets, and it creates non-financial incentive for companies because now their boss is not the customer. Their boss is the shareholder who normally wants profits, but in this case, that may not be what the central bank wants or profits. They may want something else. And the last problem, which is the biggest one, okay, so the Fed buys shares. It looks like it works. The stock prices go up. When and how does the Fed start to sell those shares? Because when the Fed sells the shares, what's going to happen? The stock market's going to go down. And what does the Fed do when the stock market goes down? They try to boost it back up. So it'll just be a game of self-dealing. The stock market goes back down. So instead of lowering rates, they just buy more shares. And then it just seems to be a circle where the Fed is just going to be playing and moving the assets back and forth just to create a higher stock market. And again, during this whole time period, the economy doesn't do any better just because the share prices are higher. So central banks get these ridiculous ideas and they make them seem normal. We've seen the elimination of large bills, and the ECB is limited to 500 years. The way they come about these concepts of eliminating large bills, cashless society, artificially low rates, negative interest rates, quantitative easing, monetizing government debt, age, all these things that would seem ridiculous to be normal, buying corporate bonds and stocks, is they start to talk about them at these speeches. They seem harmless. They're at Jackson Hole. Then some intellectual like Larry Summers or some other policy maker like Rogoff, people that are in academia start to give credibility to these ridiculous ideas. And then some central bank in the world does it, sets a precedent, and then as you hear Janet Yellen saying, oh, we're restricted, other central banks buy stocks, maybe we should. And next thing you know, it's normal policy that central banks should need to buy stocks, and any central bank that's not buying stocks is behind the curve. And now you've created a new normal. You have central banks doing ridiculous things, and you have no growth in the economy. You have the death of free markets. The concept that central banks need tools to intervene in the economy is at the root of sluggish global growth. Each intervention leads to more intervention that, rather than ameliorating financial conditions, only makes things worse. Thanks for listening, and don't forget to subscribe to Smaulgld. You'll get a free report, 12 differences between gold and silver, emailed directly to you. The subscription is free, and please subscribe to this Smaulgld YouTube channel. Thanks.